Hi, and welcome to the Stockscores Market Minutes for December 12th, 2014. This week, I want to talk about the interconnected nature of markets. You know, in the recent few weeks here, we've had a real downdraft in oil prices, and that is beginning to affect the sectors outside of the energy sector. Now, originally, it was just a problem for the energy sector as oil prices fell, but more recently, we've started to see a pullback in the overall stock market. And the reason, of course, is that lower oil prices threaten the economies of oil countries, and we could see those countries start to default on debt. And then that trickles down to having an effect in the bond market and that sort of thing. And we've watched in the last little while here, and you'll see this as I go through some of the charts, that money is flowing into the safety of the U.S. Treasury bond market because of weakness in oil. Two seemingly very unrelated things are happening because of the interconnected nature of markets. And we do this because in order to assess the market and identify opportunities, you really have to look at how these sectors are connected to one another. It's a big puzzle, and by looking at all of the pieces and what each of the pieces are doing, you can get a real sense of the overall picture of the puzzle. Don't simply look at one index measurement. Consider how one sector move can affect seemingly unrelated moves in other sectors. This will help you understand the market better. All right, here is a chart of the S&P 500, and you can see that this week we had a pretty big sell-off, and we talked about this for the last couple of weeks. Why? Because the market was at the top of its upward sloping channel, and most times when the market gets up to the top of its channel, it pulls back. You can see here last spring we had a pullback, then we had another one here, and we had one here, and repeatedly every time the market gets up to the top of the channel, we get a pullback. Well, we are doing that now, and I expect that we could see some weakness early next week. But as long as this long-term upward trend line, the line that I've drawn in green, remains intact, we continue to have a bull market. Now, these pullbacks are actually healthy for stocks. They recharge buyer interest and make the market allowed to perpetuate that long-term trend. The U.S. Russell 2000 Index Fund has been stuck under resistance for most of 2014. You can see that we've had that sideways trending action. That's made it a little bit difficult to trade because the stocks that tend to be tradable are those that are lower priced, smaller cap companies. They tend to have the most volatility. Well, I want to watch this chart real closely because if it can break through that red line, and that's something I expect could happen early in 2015, we'll get a pretty good trading environment. The market's doing what we would expect it to do. It rallied up to resistance here, and it's been pretty quiet sideways trading since then. It didn't suffer as much of a downward move this past week as the large cap stocks that make up the S&P 500. Now, the TSX is really getting beat up, and I warned everyone about this a few weeks ago when we formed that falling top. So step one in a long-term upward trend reversal is a break of the upward trend line. We had that late in the summer. And then we had a rally back, which took the market up to this falling top. And then last week we broke down from a falling top, and now we're getting an even more significant sell-off. Probably getting near the point where we'll find some support, but at this point I don't think you want to be jumping in front of any of these freight trains that are headed down because they have good downward momentum. So be very cautious with Canadian stocks. Now, we should keep in mind that the Canadian market is very compartmentalized. We've got the energy and the mining sectors, which are very negative, but then we've got some of the export sectors which are doing well because of the weaker Canadian dollar. So you can still find opportunity in Canada, you just got to search for the right sector. TSX Venture is mostly commodity based, and so we see real terrible performance in the TSX Venture market. It continues to plummet to new lows, probably getting irrationally low on many of those stocks, some of them trading for a price that is less than their cash in the bank, but that is markets, and we don't want to try to catch a falling knife until this market starts to go up. I would say be very cautious with those commodity stocks on the TSX Venture. Here you can see the effect of that flight to quality. This is the chart of the U.S. Treasury bond ETF, the 20-year Treasuries, and you can see a real strong move to the upside, actually taking it up and through some resistance both at the top of the channel and that horizontal resistance from the highs of last spring. That means we probably see a pullback in the short term, but we are seeing that emotional rush to the safety of U.S. Treasuries as global markets get that pullback because of weakening oil prices and the potential for some default from some of those oil and gas economies. US dollar actually fell last week, and that could be something that supports oil next week. It did help gold this week. We'll see that in a moment, but certainly the drop in the US dollar should give some support to the oil market. Hopefully next week we'll see how that goes. There you can see the break of the short-term downward trend line that I've drawn here in red. That's the short-term line, and we broke that this week, and that points to probably more strength in gold, but big picture, we're still in a long-term downward trend. So I'm expecting only a very short-term tradable rally, perhaps taking the gold market up to that more flat downward trend line that you see there. And finally, we got two charts of, here's a chart of oil, and you can see there that we've really been pummeled to the downside on oil, far below the downward trend line, and you can see that that trend line is going parabolic to the downside. That means that this is becoming a very emotional, irrational sell-off in energy, and that usually is nearing the point of a bottom. So I do think that we're going to see a bounce back in oil soon. Shorts will start to cover their positions. We already see that oil and gas companies are limiting the amount of exploration that they're doing. They're going to shut down some of the production where it's not economical. Those things pull supply back, and that will help give some support to oil. Now, there is still no sign of a bounce. I want to stress that. Until you start to see oil go up, don't try to catch this falling knife, because it is exactly that, and you can certainly get hurt. There you can see the spike in the fear index, the VXX, and that has been a good place to trade this past week. I recommend traders keep an eye on this one and its inverse, the XIV, because they will have the kind of volatility that you can make money from trading those ETFs. So my outlook then, bullish on US stocks long-term. Short-term, I think we could still see more of a pullback, so I've got a bearish rating in the short term. Canadian stocks bearish on both time frames, bearish on gold, but neutral in the short term, as I do think that we're going to see a little bit of a tradable rally over the next week or two. Oil bearish on both time frames, but heavily oversold in oil, and so we are nearing the point where we will get a bounce. US stocks are pulling back from overbought conditions, but the long-term trend is still intact. Canadian stocks are suffering from commodity weakness spilling into other areas of the market. Weakness in the US dollar this week may give commodities a reprieve, but I want everyone to stay cautious. Don't try to be the hero trying to pick the bottom. Wait for these things to start to go up. Well, that has been the Stockscores Market Minutes for December 12th, 2014. Have a great week in the market and trade well.